We're on chapter 2, which is a review of finance. Actually, it's a review of accounting and finance. Now, most of you remember all your finance and accounting classes, right? Oh, really? So we're going to do a review. I'll give you some resources in case you're a little rusty. And I'm going to give you an example from the book just to remind you of things that we do when we do financial analysis, which is a precursor to a lot of work we do in forecasting and budgeting. So we're going to look at financial and managerial accounting, which is a baseline of information and sources. Then we're going to look at financial analysis and tools I'm sure you're familiar with, things like trend analysis or common size analysis, and of course, ratios. Before we move off this slide, look at the comic. This is great. Now, what's the bad news? Customer service up, profits down. We want to have relevant measures. We want to measure both, actually. We don't mind if we measure customer service. In fact, it's preferred to make sure that the company is not eroding in its potential and its servicing of its customers. First, when we look at accounting, it's broken into two subsections. One is financial accounting, the other is managerial. In financial accounting, which is what we normally see as users of financial statements, they're based on generally accepted accounting principles as set forth by FASB and SEC in the United States and by other governmental and professional organizations in other countries in the world, notably the International Accounting Standards Board for much of the rest of the world. The accounting process is something that you will not have to do much of, but it's important to understand how the numbers get to where they are. And if you're doing the budget, you fit into the entire reporting machine, because we'll have actuals, we'll compare the budgets, and the result will be a budget variance. So the interplay between a budget and an actual is very explicit and happens every single month. For the annual report, you remember the normal contents of the 10K. Those include the management's discussion and analysis, which is not audited, but it is the management's view of what happened this year. Always read it, but always read it with a little bit of grain of salt because there might be a little spin and selective information, but nonetheless, most of it's valuable and it's nothing you would ever skip. The 4 statements that we look at for any company. That's one nice thing about accounting is that there are 4. Some people think there are 3, but there's actually 4. Balance sheet, income statement, statement of cash flow, and statement of changes in shareholders' equity. The auditor's report is a report of the outside auditors basically saying to the users, you may use this for your analysis. It takes a lot of paragraphs to get to that point, but we're looking for some key phrasing, namely that the statements present fairly, those are the key phrases, the financial results, and that's what we're looking for as users. We don't want to bother wasting our time on statements that do not comply with GAAP and do not purport to the rigor of a properly conducted audit. The next letter that you'll find in 10Ks is the corporate responsibility for a financial report. This is the one that's signed by the CEO and CFO. It is a result of Sarbanes-Oxley when there was so much fraud and abuse in financial reporting. Now there are stiff consequences for companies where senior management does not confirm their primary responsibility for the financial statements. And those are signed by the CFO and CEO and predominantly covers internal controls, again, as validation that we can use these numbers and we can rely on these numbers for our decision making. And last but certainly not least are the notes to financial statements. Statements could be 300 pages long. If you looked at a Citibank report, it's 300 pages. What's in those 300 pages? There are 4 statements and a couple of letters. Well, the answer is normally a lot of notes. So the notes are integral to the financial statements. In other words, you can read the 4 statements, but without going through the notes, you'll be missing things. So these are required disclosures. They are covered by GAAP, and so they should be at least perused to make sure you understand what's in those, and certain sections are obviously more important than others. On the right side, we have managerial accounting. Now, this is the perspective of inside the company. Very easy to differentiate. Financial is outside reporting that anyone can see if you're publicly traded. Managerial accounting is reserved for insiders who are managing the business. So we would have all types of very confidential, private information about products, profitability, and we would not share this with the outside world. But if we're inside, we want all that information to make proper decisions. These are including the things that we're going to look at, budgeting. We would not disclose full budgets to the outside world. We may give them summary level information about our expected revenues or expected profits, but we would never provide the line item detail of a budget. But we certainly would in managerial accounting. Next, we do cost analysis, where we look at product costs, overhead costs, because allocations are important. If we want to say, okay, we have 5 divisions, which one's profitable? Well, we will not run those 5 as completely separate companies. There are shared services, there are shared resources, there are shared physical plants, things of that sort. So the allocations, as tedious as it may seem, is actually quite important in performance measurement, particularly as we have more and more complex organizations. Third is capital budgeting, one topic we'll use quite a bit because these are major investments which are somewhat discretionary. We have things we could spend money on that pertain to physical plants, like building a factory or a new warehouse. They could be major projects like new marketing initiatives or R&D initiatives, or they could be part of a merger and acquisition strategy where we integrate the 2 companies together to form a hopefully bigger and stronger company. We have performance reporting, which is to supplement information we get to provide some benchmark on, well, we have numbers, is that good or bad? So we often need to have some supplementary benchmarks, both internal and external, to evaluate how we're doing against our targets and against our competition. Finally, we have some other traditional managerial accounting topics that we will not delve into much in this class. They are cost, volume, profit, where we're looking at the behavior of our cost. As our volume rises, what happens to our cost? We would hope that the costs decline over time. And this is an important aspect when we do our profit planning. So CVP, as we normally call it, or more affectionately, we call it break-even analysis, which is only one of the scenarios of CVP, right? We don't want to just break even, we want to earn a profit. So break-even is just one example how we use CVP relationships for break-even purposes. And last, decision-making models. This is a constant area that business people, specifically finance people, do. We create models to either do analysis or projections. So we'll be doing modeling throughout this course. Again, budgeting, capital budgeting, and forecasting are all model related. Generally accepted accounting principles. Why do I need this? First of all, it governs how financial reporting works. So they're the rules by which the statements are prepared. So you might say, I'm a logical, intelligent person. Why do I need to understand GAAP? The reason is some of the rules may be inconsistently applied to different circumstances or different types of transactions. And worse, sometimes they'll seem illogical. Just to give you 3 examples, among many, unfortunately. Cash and marketable securities are stated at market value. Cash is cash. There's no controversy there. But marketable securities can be sold on the open market, like stocks and bonds. So they're shown on a financial statement at the market value. We call that mark to market. However, other assets, such as land and buildings, are at historical cost, which could be dramatically undervalued to today's value. If Walt Disney bought the land for Disneyland 70 years ago in Anaheim, he probably didn't pay that much per acre for that land. However, now it's worth quite a bit of money. If you look at the balance sheet for Disney or any other company, land and buildings are recorded at historical cost. That's the gross asset value for fixed assets. So it could be very much undervalued. So we have things like cash and securities, which are market value, and we have other significant assets, such as land and buildings, which are systematically undervalued. So we can't say one or the other. It depends, like so much we do in accounting. The second example is intellectual property. Disney, staying with the theme, acquired Marvel. Along with that came Spider-Man. So the intellectual property that is captured by the characters, like Spider-Man, are on the balance sheet of Disney. They're shown as goodwill because they paid a lot of money for Marvel. However, something like Mickey Mouse or Donald Duck are created by the artists in the Disney studios who were employees of Disney. Those are not acquired intellectual property. They were developed by internal resources. Therefore, they're not on the balance sheet of Walt Disney. You might say, that's not fair. Spider-Man is similar to Donald Duck and Mickey Mouse in importance. But that's how it is. So accounting rules have consistency within itself, but sometimes you'll look at it and doesn't make sense. The last one is shareholders' equity. This is often seen as a confusing item. It says assets, liabilities, equity. Therefore, equity must mean that the company is worth that much money. Wrong. Shareholders' equity is an accounting creation. It is based on all the rules that we apply for GAAP. It does not purport and normally does not bear resemblance to the market value of a company, because the market value, as you recall in finance, is based on its future. Financial statements are largely based on its past. So therefore, we're looking and measuring two completely different things. So book value and market value are significantly different. Therefore, because of all this and many other reasons, we have to understand accounting enough to understand how to analyze and interpret financial statements. Otherwise, we would make mistakes, and we don't want to make mistakes. Okay, accounting process. Isn't that bookkeeping? Why do I need to know it? Well, you don't need to know it because you're not going to be doing accounting per se, but operating budgets are a key component. So you'll work closely in conjunction with the financial accounting team to fit in the budgets and the analysis during the calendar that is the reporting calendar. So we're going to be providing budgets well in advance of the beginning of the year, and each period we're going to be comparing and analyzing the variances that come. Another reason we have to understand it is when we create budgets, they have to fit into the line items that will match the reporting statements. Something like marketing. You have an advertising. Oh, well, let's just call it marketing. Well, that's not nearly precise enough. You'll probably have a more detailed subcategory of marketing called marketing-online ads or marketing-advertising. And that's where we want to budget. We want to budget at what we call the most granular level, the lowest level that matches the accounting description, so that as we do accounting, we have actuals and we'll have a budget line item that is budgeted for that line item. If you just budget overall marketing, then all the expenditures within the marketing budget would get mashed together in one big number. That's not exactly good cost control. So operating budgets must align with accounting so that the actuals can line up against budgets and we can make meaningful judgments about how we're doing this year. The other reason is, let's say your analysis leads to some ambiguity or questions. You'll need to know how to ask the right questions to get the answers to why something happened, so you will be credible when you interact with the accounting staff that can give you the answers to your questions about the budget variances. So you're correct, you're not a bookkeeper, but you do need to know how bookkeeping works and how accounting works. Next what are the financial reports that are required? We know that there are groups of filings that go to the SEC. Notably, the 10K, which is the required annual report. Then there are required quarterly reports, 10Qs. These are not complete financial statements, but they do highlight the major metrics of that quarter. Things like revenues, profits, earnings per share. Then there are these other reports called 8Ks that are not regular, but they are quite specific, and when they occur, they must be filed. Examples of events that are 8K would be you have an acquisition that you are contemplating and you're discussing, or you have been sued by a major customer for a loss. That needs to be disclosed. Or there's a major changeover in senior management of the company. 8K reports are therefore important, but they're not regular because they're not tied to time, they're tied to events. The other thing in an annual report that's very important, as mentioned, was the MD&A, and these are required for the SEC disclosure and valuable to us to read as some measure of what's really going on. Otherwise, we'd have to be interpreting, and you may not have access all the information needed to understand the business thinking behind what moves were made by the company. So other reports that are issued, one is called the annual report. Wait a minute, we just said 10K was the annual report. Well, there is a difference. The 10K is the annual report that goes to the SEC, and that's required, and it's in an exact format, down to the item numbers in the order that's prescribed by the SEC. Annual reports are required by your shareholder agreements. When someone buys your stock, you promise to them that you will provide an annual report. It doesn't have to be this 300-page document that you file to the SEC. That's a pretty scary, hard to read document. You can, note the word can, issue a more friendly statement that has pictures, graphs, explanatory information that is more reachable and readable by the users of your financials. Users of your financials could include, of course, shareholders, but you may give the annual report to a supplier. You may give your annual report to a recruit. You may give your annual report to a customer since they're public in anyway. So in the past, they've been used for multiple purposes to multiple stakeholders. What we find, however, is that the internet and the ease of information, both in dissemination and in conveyance, make it so we don't need to spend the time and money for a separate glossy printed annual report. We now find that most companies simply take the 10K, as ugly and difficult to read as it is, and give it to shareholders as the official annual report to shareholders, which is completely legal because it is the annual report. It may not have all the friendly trappings, but it does comply with the legal standards for running a corporation. So that's what we do today, is that we tend to minimize the amount of paperwork and issue one statement, and the rest of information we supplement with online and other forms of communication. So generally, FP&A is not directly responsible for that financial reporting, but you may be asked to help analyze and test the reasonableness of the disclosures and the information provided. You'll also be asked to do perhaps some of the risk assessment. In every 10K, there's a statement related to the risk factors in a business, and FP&A, since we look at all angles of the company, are in a good position to articulate the risks that are inherent in the business. The accounting statements, we already mentioned the 4 basic statements, and the accounting processes are underlying those statements. That's why we need to have some base level knowledge, and we need to understand the role and the interests of the outside users and stakeholders. What are they using it for? Therefore, we may supplement our disclosures with things that we know that they're particularly interested in. So there are requirements that often are viewed as the minimum. SEC and FASB will require the minimum amount you can say about segment information, and you have to provide certain delineation of your major lines of business and certain financial information at the segment level. But you're free to provide more detail if you'd like. Companies tend not to provide more detail because that's the good stuff. That's the competitive information. But they are free to do so if they'd like. One of the aspects we do quite a bit in this course is to look at financial analysis. We also see regularly used in FP&A other topics that we see from accounting. They are things like compliance matters with the SEC or the IRS. We also see that there are processes the FP&A is involved with, such as allocations. As I mentioned before, we're not going to do allocations in this course. Then we look at the economics of the business. These relate to the profitability and other analysis of unit costs. These are also possible areas where FP&A can assist management in doing objective analysis. Also, there may be new financing, new bond offerings, equity offerings, or loans. We may be asked to support those efforts with supplemental information. And finally, in the case of a mergers and acquisition scenario, we may be asked to be part of the screening, the due diligence, or the integration planning with regard to that acquisition. All right, next is the subject of managerial accounting. It's useful. Some of the basic information from managerial accounting we may just know and be part of our underlying thinking, like the flow of costs, materials, labor, manufacturing process. Others would relate to things that we will specifically cover in this course, such as operating budgets, sometimes called the master budget, or capital budgets, which are the major investments, or performance reporting, like balanced scorecard or integrated reporting. So we'll do that specifically in this course. There are other things that are used in FP&A, but not covered in this course. So what if you're rusty in accounting, financial or managerial? Well, first you have your old notes and your old textbooks from your classes. That's always there. Secondly, from my classes that I've taught over the years in these 2 topics, I have summarized those courses for my students. In the past, it was for their studying for a final exam, but they may be useful for you just to scan to refresh your mind of the terminology and some of the definitions that we often see here. I have 2 separate documents. One is for financial accounting and the other is for managerial. The format for these, we call it Key Concepts and Techniques. And on the right side of the screen, you see an example. is I have the objectives, key concepts and terminology, and on the bottom are the analytical procedures. So if you flip through this, and it's 1 page per chapter, it summarizes the chapters we covered in financial and managerial accounting. Also, for your purposes in this course, I've highlighted the ones I posted. The yellow represents things that we'll likely use, and you'll see this in this course. And then the blue, it's good basic knowledge, and it may come in handy as we cover some of the things we'll cover in this course. If it's not shaded in yellow or blue, it's not that it's not important, it's just not relevant to what we're going to be doing in the next few weeks. The other choice is to ask me to meet during office hours. I'm happy to meet at a scheduled time that we could do with the team or with you individually. So I'm going to look at example statements. Here we'll look at the statement for Best Buy. You probably know them. They're a major electronic retailer in the US. And the balance sheet, first of all, is the accounting equation. Assets equals liabilities and equity, which very simply says the company, Best Buy, has certain assets. Well, how did it pay for those assets? They either borrowed money or they got money from owners. And that's all a balance sheet is. It's a statement of position on a specific date and time on what assets they had and how did they go about financing the acquisition of those assets. Therefore, we have insights one level deeper. What kind of assets do we have? Is it cash? Is it receivables? Is it inventory? Is it physical plant, like stores or factories? What is it? Also, who do we owe money to? Do we owe money to our vendors, our employees, the government, lenders, bondholders? Who do we owe money to? So the right side, or the liability section of the balance sheet, describes all the creditors that the company has. And finally, who owns the stock? Is it common shareholders, or do we also have other classes of stock, such as a Class B common or a preferred? And also, over the time that the company's been in existence, how much retained earnings has it accumulated? Retained earnings being the profits earned by the company minus whatever profits were paid out to their shareholders. In other words, retained earnings, earnings that we retain. So that's what we have. Money from owners, either from capital contributed, buying stock, or from retained earnings. The functions of this particular statement also allow us to evaluate basic things like, can they pay their bills? We often call that liquidity. Or do we say, do they have too much debt? We often call that leverage. So you'll see that we'll categorize the ratios into certain subgroupings that give us insights into how the company is doing. The second statement, the most often looked at statement, is the income statement. Now here we see, I call it income statement, Best Buy call it statement of earnings, and what you'll see is many of the things we do in accounting often have multiple names for the same thing. So here, the simple summary is it's revenue minus expense equals profit. Okay, got it. I know what profit is. So what do we get? We get insights on revenues. What is it this year? What are the trends? We look at where did the money go? Is it cost of goods sold? Is it salaries, rent? Where did the money go? And then we have multiple levels of these subtotals, which are all useful. Gross profit, operating profit, pre-tax profit, and net income. So these are items that we do in order to probe where the company makes money. If it's doing well, why is it doing well? If it's doing poorly, why is it doing poorly? Some of the evaluations specifically we would do are on profitability. As a percent of sales, how much money does a company earn? How much of sales do we spend toward R&D? Or how much do we spend toward fixed expenses like rent? Or we look at what is the growth rate in profits and in revenue. These are all the types of analyses, tend to be quite important analyses that we do related to the income statement. Next is a statement of cash flow. The statement of cash flow is in 3 activities: operating, investing, and financing, which says how much cash did we generate from running the business, operating, how much money did we invest, and in what did we invest? Did we buy physical plant, or did we put money away for a rainy day by buying marketable securities? They're quite different, but they're both investments. And the third category are financing. Did we borrow money? Did we repay loans? Did we sell stock? Did we repurchase stock? So this is all about the financing activities. It's a very useful statement, and it's kind of underappreciated, but it is one of the more powerful statements because without cash, we're in trouble. So one of the key aspects of running any company, big or small, is cash flow. And this is a statement that helps us dive in and dissect where's the money coming from. The last statement is a statement of changes in shareholders' equity. As mentioned, it talks about the stock that we issued, stock that we repurchased, also retained earnings, and we have this other item that often people don't pay much attention to. It's called accumulated other comprehensive income. This is a very technical area. I will not get into it during our course. It's part of financial accounting.